Good evening, friends. I hope all of you are keeping great and welcome you all for the second session of this investment decisions. And I'm sure you got a chance after the last lecture to go back, study some concepts with respect to the non-discounting techniques and the discounting techniques. I'm sure we are all looking forward for a good knowledge enriching session, which will continue or resume our discussion on the NPV and IRR techniques. And we will have a lot of fun today, including some practice as well. So welcome everyone. So we, towards the end of the last session, I had briefed you about the discounted payback, and also we also discussed about the IRR. What I would like to start today is something called a modified internal rate of return, guys. Now, we discussed some issues with IRR method, right? Let's see who remembers that. First question straight away to you guys. I had talked about a couple of issues with IRR in the last lecture. Do you guys remember at least one of those issues? Let's see what are your responses on this one. So my question is, what were the issues with respect to internal rate of return, what we discussed in the end of the last session? Let's see if anyone remembers those. Okay, so let's see what are the responses. Okay, I can see a response coming in from Siddharth. Siddharth says complex calculation. Siddharth, apart from that, so you're talking about the disadvantage, but I was talking about the issues, right? I'm not talking about the disadvantage or challenges in calculation, but it's like some issue. If you remember, guys, I told you a couple of things with respect to IRRs. In fact, let me go back. This particular slide on the screen, right? We talked about when there are outflows, more than one outflow or other. You have an initial outflow and there are subsequent outflows. You may end up calculating multiple IRRs. Then the reinvestment discussion as well, right? Reinvestment at the IRR was less realistic than the reinvestment at the cost of capital itself, which is assumed by NPV method. So those were the issues we discussed, guys. Now, what does this talk about? Now, modified internal rate of return definitely tries to address one issue out of those. The issue with a conventional IRR that relates to the calculation of multiple IRRs. Now, how is that possible? Guys, we are calculating the IRR at the beginning of the project. Right, Hitesh? I think I can see your response. Good. So the multiple IRRs is like, because we had multiple outflows, but we calculate the IRR at the beginning of the project. And the problem we face is because probably the cash flows reverse their signs if there are multiple outflows. Why don't we do one thing? Why don't we actually compound all the outflows and inflows, all the cash flows towards the end of the project? So what I'm talking about is, so let's say we are having this kind of a project life where we have outflow here, we have outflow here, and we also have outflow here. If we start calculating IRR at this point, it becomes difficult. But what if we can compound all these values towards the end, towards the terminal stage of the project? Don't you think it can help a bit? So not only it may help you with the addressing this kind of an issue where we are talking about multiple IRRs, but also with respect to the reinvestment rate. Now that means the crux of this particular method is compounding all the cash flows, whether inflow or outflow, except for the initial investment. We don't do that to the terminal value. So any outflows during the project are taken care of. And then what we will do is we will probably equate that particular outflow with a discount rate, which will equate the terminal cash inflow to the 0th year outflow. So what does that mean? Let me give you a little bit of a more idea by taking an illustration. At the bottom of the screen, an investment of 1,36,000 yields the cash inflows, profit before depreciation but after tax, of 30, 40, 60, 30 and 20 in 5 years respectively. And what we are calculating is MIRR considering 8% cost of capital. Guys, what did I talk about in MIRR? We are talking about compounding these. So can we see the cash flows are compounded towards the end of the project here? This is the compounded value, guys. This is after 4 years, 3 years, and so on. The total compounded value is 2,13,587. Now, let me draw a line. What we are doing is we are compounding these values towards the end. So we have on the other hand of this line a compounded value of 2,13,587, and we have on the left hand side of the line the initial outflow of 1,36,000. Can we now calculate the rate at which the present value of that 2,13,000 equates 1,36,000? Are you guys getting it, guys? Basically, what we took was we basically compounded all the cash flows towards the end, and now we are left with two numbers: one on the other side of the project, one on the beginning of the project. So we need to just calculate that rate at which the present value of that single number equates 1,36,000 here. So basically, what we are looking at is that 2,13,000 into the present value factor will be giving you the 136, and hence the present value for 5 years would be a 0.6367. And when we look at the annuity table, it is approximately 9%. Guys, do you agree with me that yes, if there were multiple outflows here, the issue is resolved because we have compounded all the values to the end, and then we are calculating one value comparing to the initial investment, yes or no? What do you think, guys? This will resolve that issue probably. So let's see your responses. What is your opinion on this? Okay, I think looking at the responses, I guess you guys are understanding what I'm trying to say here is that resolving one of the major limitations of IRR. Good. So that means, so any doubts, let me know, guys. Wherever you feel that, okay, you want to clarify something, please let me know. Okay, so moving ahead, let me also show you some interesting facts wherein IRR and NPV could give conflicting conclusions. Before that, let me do a quick recap of one important factor which I mentioned in the last lecture on Saturday. If you remember, we were talking about that IRR would generally favor the projects which are heavy in terms of inflow in the earlier years. We discussed this, right? IRR generally will favor those projects because it's not an absolute measure. On the contrary, NPV will definitely favor those which have positive NPV. So let's take some examples here. The first point where these two methods can be contradicting to each other is that projects involving different scale or different size. We know that IRR is a relative measure and NPV is a absolute measure here. You can see it as an example, project A and project B. Project A is just 20% in size as far as outflow is concerned. And the IRR For this project, look at the same 50%. NPV 36,680. But if we ignore the NPV of 36,000 something, we look at another project which is 5 times big, 5 lakhs outflow with a 6,25,000 as an inflow. Anyone can say that, okay, this NPV looks much huge, but IRR is low. Now, one can argue here is probably the risk in the project B could be slightly high because you are kind of fixing in your 5 times the funds, but that's okay. So you're talking about, yes, IRR is low, but NPV is high in the absolute measure. We're talking like 5 times the funds. That's absolutely fine. But having said that, do you guys agree that yes, there is definitely a factor which entails this point that there is a contradictory opinion in terms of the project evaluation, guys? And very clearly, it is evident that the IRR is kind of favoring more from a relative measure perspective in terms of the ignorance of the absolute numbers. Okay, looking at the responses, Hiral has a question. Again, Hiral is coming from the last slide, how we got 9%. Hiral, did you try to look at the annuity table for 5 years? Did you actually do that? 0.6367? If not, I think you should do that, right? Did you try to do that? So let's see this. If you are still not clear, we're talking about 5 years. And let's see where is 0.6367 coming out to. So do you agree that, guys, probably the 0.6367 or 0.64 is near to 9% from here? Are you getting it? This is what we were discussing there. So we did not say it's 9% accurate. We said approximately 9%. Are you getting it? So basically, you guys need to refer the annuity tables on. Generally, they'll give you the abstract or the factors itself. So don't even worry about it. Hiral, I hope that is sorted. Okay. Gayatri says, how to remember all this? Gayatri, repetition, revision. You need to complete the course, you need to do revision, you need to study, and of course, you will be able to remember. Okay, guys. So the first contradictory factor is your scale. The second is the important point, which is like time disparity. And this is what I already discussed on Saturday, that IRR will generally favor the projects which have heavy inflows in the earlier years. Probably indirectly, I'm trying to say that it is not favoring the projects which have heavy inflows towards the later part of their life. That is, the larger part of cash flows may be occurred in the beginning or end of the project. But what IRR will do, look at the scenario here. Project X has heavy inflows at the beginning, 2 lakhs, 1 lakhs. And look at the IRR, 24.87. Whereas the project Y has a higher NPV, but has a lower IRR here. Why? Because look at that. Their inflow is kind of coming up at the flag end of the project here. So that's the second piece. Now, projects with unequal lives. Now, I will talk about a solution for this also. Projects with unequal lives. So, if there is a disparity in lives, there also, we are talking about different conclusions. Project X, for an example, just 1 year, all the return in the first year, 50% IRR. But I think this anyways resembles the example where I was talking about that, yes, heavy inflows in the later years, that project is definitely not recommended by IRR, but definitely yes by NPV. And look at this. This is a perfect classic example where both the projects have initial 5 lakhs outflow. Project X also, project Y also. So in terms of risk, I would say that, okay, you're getting all the funds in the first year, but you're ignoring that, okay, the other projects are actually profitable in the long run. Now, for this kind of scenario, we have a technique called as equivalent annualized criteria, which I will be talking about in upcoming slides. How can we, sort out this issue? Probably we can assume that we can repeat a project with a shorter life. We will talk about that. Okay. So, very important aspect here. Guys, you remember when we started capital budgeting, we talked about why capital budgeting and investment decisions are important. I hope you remember that one of the major factors was that we have limited funds and these decisions are irreversible and relate to the long run. And when we say limited funds, we're talking about capital rationing here. And we have talked about that in terms of the wealth maximization, following a discounted technique, which is an NPV, will always probably target the projects with higher NPV. And if in our budget, if we have capability to take more than a project, we will choose that combination which will maximize NPV. I hope that is clear to everyone here. Okay. So there is a doubt. I have a doubt. Is IRR is equal to N? Okay. So there is a doubt coming in from IRR. So IRR is that rate at which NPV is 0. That is for sure. IRR is that rate at which NPV is 0. So that means we do not, in IRR, we are not even considered about what is the actual return of the project. That is considered by NPV at least in terms of absolute measure. I hope that is clear. Right? So the idea here is that, yes, although we are talking about like positive NPV project should be accepted, but the point is when a capital is constrained or limited, which is generally the case, there we might have to select only one project or in fact, we can't select all the projects, right? Now, one factor which we need to consider in this case is, in case we have multiple projects in front of us to evaluate, are any project of that nature, which means that, okay, project may be taken in part, or are we talking about like, can there be a project which is divisible in nature? Now, that could be possibility hypothetically, but what if realistically the projects are not divisible in nature? I would like to talk about this part first. Generally, you might agree with me that projects are not divisible in nature. That's okay. If projects are not divisible in nature and there are, let's say, 4 or 5 projects, what you do is you calculate the NPV, you rank them on the basis of absolute NPV. And basically, you will select those projects or that combination of the projects that can give you the maximum possible NPV. And probably it may result in some amount of funds unutilized. See, the reason is, Smita, I'm just looking at your doubt, just give me a second. Okay, so the reason is that if the projects are not divisible, it could be a very, very tricky situation that, okay, I come up with a combination of the projects which maximizes the NPV, but also utilizes all the funds. So there could be a chance where I'm having 5 projects, project A, B, C, D, E. And let's say project B and E are the maximum NPV, but that doesn't mean that your entire capital will be used, right? So that's one thing. So Smita has a doubt. IRR and NPV at beginning inflows is clear, but how it can be linked with life of the projects? Okay. So Smita, with respect to this, I would like to go with the last example. You can see project X and Y. Y is having a life of 3 years and X is only 1 year. Now, because project X is kind of heavy in terms of the initial inflows or inflows in the initial years, we are favoring project X if we would have taken decision based on IRR. But if I'm talking about decision based on NPV, then definitely the answer is project Y. What I will be talking about in the upcoming slides is a scenario where, let's say, one project is of 4 years and another project of 2 years. Can we just decide basis that information, or can we actually come up with a proposal that, let's say, the project A, which is of 2 years life, can we have 2 projects of 2 years and compare them with the 4-year project? We'll talk about that. So I hope that makes sense, because with unequal lives, you cannot take a decision as such. This is what I said. But yes, practicality, theory are different things. In real life, you may get an opportunity of the similar projects of a smaller life or may not be. but at least we should know all the possible tools and solutions as a finance manager as we may have. Smita, I hope that is a little better for you now. Great. So we will talk about that. We'll go into a little bit more detail on that topic. Okay. Now coming back to my discussion on the projects that are not divisible in nature, we go for that combination where the NPV is maximum. But there could be a situation where where you get an opportunity, you are getting to select part of the project as well. Now there, the best thing is that you may be able to utilize each and every rupee. Every single penny of your funds can be invested. However, in that case, the ranking should not be based on the NPV or absolute NPV. Rather, it should be based on NPV per rupee of capital. That means we will divide NPV upon the initial investment. That is NPV per rupee of capital, and we'll rank the projects on that particular basis. Let us try to look at these possible scenarios with the help of an illustration here. At the bottom, you can see Parvati Limited is planning its capital investment program for next year. It has 5 projects, all having a positive NPV. That's absolutely amazing. Cutoff rate 15%. Investment outflow and present values are given. And company is limited to capital spending of 1,20,000. Wow. So let's see. What we need to calculate here is what is the best possible combination. But definitely we have to take into account A, whether the projects can be divisible, or B, whether projects cannot be divisible. So let's look at project A, B, C, D. We have investments, different amounts. Guys, can we please have a look at the total investment required? 50,000, 40,000, 25, 30, and 35. So if we see the problem here is we are having budget of 1,20,000. But if I add the investments, I'm getting 1,80,000. I'm getting 185 if I probably decide all the projects. Can I really invest in all? No, I can't. I really can't. Now, we see NPV. Now, guys, if I want to rank the NPVs in absolute terms, I can see that project E is having the maximum NPV. So that's number 1. Project B is having the second NPV. Now, let's go to the third one. But imagine, as I go to the third one, do I have the enough funds? I have 1,20,000 funds, guys. So E and B, if I have 1,20,000, if I invest in E, is 35,000 gone? If I invest in B, 40,000 gone. How much I left with? 45. But the third rank, project A, is only 50,000. So we do not have enough funds here. We have 45,000 only. Probably you may have to go for the fourth option then. So guys, it's very important that the top 3 combinations with project E, B, and A, we don't have enough funds. But if we go with E, B, and D, definitely you have funds because project D is requiring only 30,000. So out of 45, if I go for project D, I am actually left with 15,000, but unfortunately, I can't do anything about this. This is not utilized. However, because I ranked them in absolute NPV, I am having a good NPV here. With E, B, and D, I'm having an NPV of 19.3 plus 18.7 plus 15.4. Or rather 11.2, not even 15.4 because A cannot be done, right? So E is 19.3, B is 18.7, that's 38. And then we go for project number D, 11.2. So your total NPV is 49.2. Guys, if we consider other combination also, just to cross check, it is always good whether any other combination can give a maximum NPV. In this example, project E, B, and D are looking good to me. There could be a situation, and I'm sure you guys can agree or disagree with me. There could be another example where, let's say, ranking 1, 2, 3, you don't have enough funds, but you can invest if you invest in projects 2, 3, and 4. But what you have to see is combining NPV of 2, 3, 4 is better than any other combination or not. What I'm trying to say is an important message. When we are talking about multiple projects, it may not be necessarily the best project itself will be part of the maximum NPV. I hope that makes sense, because you need to see that combination which will maximize the NPV here. Okay, so guys, that is the point where the projects are not divisible. Is it clear to everyone? Projects are not divisible, so we go for that combination where the NPV is maximum, and also because those are not divisible, your funds may be unutilized, like we just saw. Within the same example, if we assume that okay, funds are divisible, let's say, or rather projects are divisible. So guys, if the projects are divisible here, how would I rank? Would I rank based on the absolute NPV? I don't think so. In that case, I will calculate NPV per rupees of investment, guys. So what did I do? I am doing a absolute NPV, that is 15.4. I'm divided by 50. So I get 0.31. Similarly, I'm doing like 18.7 divided by 40. I get 0.47. Now, as I did that, I calculated this and my rank slightly got changed. Project E still lacked, kind of in terms of the number 1. And then we're talking about second in terms of the ranking is project B here. And third is project C is 0.40. Interesting point is, if I include E, B, and C, how much funds I have invested, guys? We just can quickly calculate. 100,000, 1 lakh. E, B, and C, guys. E, B, and C. 1 lakh is invested. And my fourth rank is project D here. The interesting part is, if I'm going with this 1,20,000 and the projects are divisible, I take away E, which is 35. I then take project B, 40,000. And then finally, I took project C also with 25. Yes, it is very evident that I am left with 20,000 and project D is having 30,000 as its requirement. But since my assumption is that project is divisible, can I take care of 2/3 of the project D, guys? Yes or no? Can I take 2/3 of project D? Because we are following an assumption that projects are divisible here. What do you think, guys? Let us see some responses here. Everyone with me on this? That divisible projects, you can actually go to any extent. Let's see what do you guys have to say on this. Any comments or you agree? Raghavan says it seems logical. Okay. What about others, guys? So basically the advantage in this assumption. So okay, there is an advantage, there is a disadvantage. The disadvantage is that you're probably assuming that yes, the projects are divisible, which may not be always the case. But definitely advantage is that you're utilizing all the funds you have, right? You're utilizing all the funds you have. That's it. Right? So good kind of a scenario here, guys. So let's talk about a quick calculation here. Company here is 1 lakh available for investment and has identified below 4 projects. You're required to optimize the returns from a combination of the projects with the available funding, assuming A, the projects are divisible and B, projects are not divisible. Can you please tell me the scenario A, what is the combination you want to go? Scenario A, guys. Hiral has a point. Hiral says project divisible means project can be accepted in part. Yes. Hiral, absolutely correct understanding. So let's try to test yourselves here. Can you guys tell me a part A? If the projects are divisible here, what is the combination you would go for? I'm sure the first part, what you would like to do here is calculate the NPV per rupee of investment. This is 0.5, 0.35, 0.48, right? And probably 0.30. So can you tell me what is the combination you would go with? Okay, Smita, your point with respect to was with respect to the last illustration, am I assuming? You're talking about initially we can select B, C, and we get NPV 43. So again, Smita, depends on whether the project is divisible or not. That's it. If the project is divisible, you can go to any extent, but if it's not divisible, you should select any combination which can maximize your NPV. Gayatri says only project B. Why? See, the Gayatri, my question was when the projects are divisible. Projects are independent and divisible. That's a part one of the question. Miss Khushia says ACBD. Unfortunately, you don't have funds. Funds are not there. Only 1 lakh is there. For all the 4 projects, you needed how much? 2,50,000. You can't do that. As per me, the first ranking goes to project A. The second ranking goes to project C. And then third ranking is going to project B. But can you invest the entire project B? Probably you're talking about 10% of project B. Yes, so I can see Smita, they will tell you. They will tell you the project is independent and can be divisible or not. That information you don't need to have to assume from yourself. No. So Smita, they will tell you, don't worry. So looking at the responses, guys, everyone okay here? Everyone got it? That we are looking at project A, project C, and 10% of project B. I think majority of you are giving me that answer. I'm just giving you 1 more minute. Guys, everyone okay here? Okay, Hiral says, Hiral, yeah, your answer was correct only to the extent that you mentioned D also. D is not the choice here, right? A, C, and 10% of B. A, C, and 10% of B. Okay, guys, the second scenario was projects are not divisible. Now, here I am very much interested. I think, as I said, if it is not divisible, just rank basis the NPV. Someone said, I think Gayatri said, that because it is not divisible, we simply go for the highest NPV. Guys, please listen to me. This is a classic example. If I only select the number 1 NPV, that is project B, I get an NPV of 35,000. My entire 1 lakh is gone. But guys, I want you to think calmly. Don't you think if I go with project A and C, I'm investing 90,000, but my NPV is 44? So basically, we are not going with the best number 1 NPV, but we are going 2 and 3. Are you getting me, guys? If the projects are not divisible, of course, you cannot accept part of the project. But what we can see is that it's not necessarily the number one NPV is the best. So we are talking about number 2 and number 3 in terms of project C and A. Yeah. Okay, guys. So we are talking about A and C, not project B, please. Okay, so now we move on to the discussion we were having at the beginning. Projects with unequal lives, and we discussed that yes, it is something which could be an issue with IRR, right? Now, when we are talking about unequal lives, the problem is that if multiple projects are there, how can we select a shorter one versus longer one? Or what about the equipments we have? In that case, there is a method we can use, which is one is replacement chain method or an equivalent annualized criteria. Let's discuss them one by one. What is this method talking about? Now, under replacement chain method, there is an important word which can help you to recollect. I think some student asked me that how we can remember or all these concepts. I think the keywords can be literally a trick here. So if you can associate some keywords with respect to your understanding, guys, you will definitely help yourselves. Let's say in the replacement chain method, we are saying that, okay, we can repeat the shorter projects multiple times until they reach the lifetime of the longest project. So for example, if one project is 3 years and the other project is 6 years, you can repeat project A twice. But the only problem is in practical life, would you get those opportunities of smaller projects with equal lives? Or second is, you probably can apply only when it is in exact multiple, right? To have a comparison. But how to remember this? Hiral had a question, only A and D can be accepted in non-divisible. Hiral, what happened? We just discussed in the last slide. In non-divisible, we talked about of A and like probably A and D with a less NPV. Why would you go for A and D? I would go for A and C now. In A and D, the NPV was 38, but in A and C, it is 44. I would go for A and C. Here we just now discussed that. A and C. Okay. Yeah. So coming back, guys, now replacement chain method. Now, replacement chain method has a term called chain. Guys, would that help you to memorize this? As in, chain means like one after the other. Replacement chain method. So you repeat the shorter projects until they reach the lifetime of the longest project. Right? See, the only point is, if I take my example that yes, project A is for 3 years, project B is for 6 years. So let us do one thing. Let us perform project A 2 times. Like once project A is complete, let's assume that there is another project A or another project like project A. In that case, we talk about 6 years of both the projects. Mind you, one repeated, one is non-repeated, but 6 years. Then we can compare the two projects easily. Smita has a question. Can you explain the non-divisible project in the previous question? Smita, I explained in the previous question non-divisible projects. If we go for the highest NPV, you were talking about less NPV. 35,000 is a lesser NPV. But we talk about the second and third combination. You had 1 lakh, right? Project C is 50, project A is 40. So 90,000, may you are getting a higher NPV, then why not? Why not? Who says to go only for rank 1? That's what I said. Yeah. Yes, I hope everyone is clear on the last slide, because I think it's better that we clear your doubts and then go ahead. Any further doubts on the last one? Please let me know. Okay, so guys, replacement chain method. Does this sound good? That you will remember this method with the chain concept. Chain. Okay, let me talk about an example here. where we'll consider both the methods, replacement chain, and there is another method which takes care of the scenario of with unequal lives. That's equivalent annualized criteria. Now, this is very interesting. I told you that yes, project A is of 3 years, project B is of 6 years, but what if project A is of 4 years and project B is of 7 years? So, in that case, would you follow mathematical LCM? I don't think so, right? You cannot keep on repeating project A and B until and unless the lives are same, right? You do not want to do that. You cannot go to 28 years over there. You cannot. Then I would say you would follow the other method called equivalent annualized criteria. Now, what is that? Here, we will calculate the NPV of the project. We will divide the NPV with unequal lives by their respective present value annuity factor. You would have present value annuity factor for 4 years, different one, for 7 years, different one. And we will divide the NPV with that, and the highest value can be selected. Let me show you this by the example here. So this Dhoom PLC is considering modernizing its production facilities, and we're talking about two proposals under consideration: Project A and Project B. NPV to be discounted as per 12%, and we are given the NPV and IRR, good for us. So let's look at Project A and Project B. What is the life of Project A, guys? What is the life of Project A here? Hiral, yes, you are correct. That combination of NPV which will give you, that combination of projects which will give you largest NPV. It doesn't necessarily be to be rank 1, okay? So guys, can you please tell me here, in terms of Project A versus Project B, what do you think? Project A is of 6 years, Project B of 3 years. If I see NPV and IRR, we are talking about conclusion as per NPV. It suggests Project A. The section I've highlighted on the blue here, as per the NPV, Project A is definitely selected. But in terms of IRR, Project B is selected. But the Project B is only of 3 years. Let's do one thing. Let's repeat Project B. So what we did is look at Project B. 2000 outflow, 700, 1300, 1200 inflow. But then we assumed at the end of the project, at the end of the year 3, we again repeated Project B. So that is why minus 2000. Minus 2000. Now if we calculate NPV and IRR, guys, what do you see here? Do you see that Project B criteria is now kind of going ahead with respect of NPV as 882? Earlier, what was happening was that you were selecting Project A based on the NPV. You were selecting Project B based on IRR. But if we consider that, okay, Project B can be repeated twice, or probably we can say that a similar project like Project B is also available after 3 years, then we see that, okay, both as per NPV and IRR, Project B is selected, guys. Can you see that? If you see my conclusion, which is highlighted in green section here, if we have that possibility where the Project B can be repeated, whether it is NPV or IRR, we are getting the choice as Project B. This actually removes the conflict of IRR and NPV. So we go with Project B. Can we say that, guys? That is a replacement chain. What is a replacement chain? That is Project B is repeated in a chain here. However, let's say we come to the reality. We say that no, Project B cannot be repeated. What do we do then, guys? What do we do then? Now, We are talking about project A's NPV is 649,094 and the present value annuity factor for 6 years is 4.112. We divide 6,49,000 by 4.112, we get 1,57,000. Similarly, project B's NPV is 5,15,000 and 3 years present value annuity factor is 2.4 and we get 2,14,000. Which project will you choose, guys? If I go with the decision of equivalent annualized criteria, which project should be selected? Any thoughts? Pooja, if it is 2 and 5, then you go for the equivalent analyzed criteria. Pooja has a question. Pooja says, what if the one project is of 5 years and one is 2 years? So Pooja, look at this statement here. What if the projects could be repeated? If the lies were not in multiples of one another, you follow the equivalent annualized criteria. Guys, everyone with me on this? Hiral, I was looking at your comment in project B. NPV is recovered only in 3 years, more than the project A of 3 years. So basically, Hiral, what we did was like we repeated the project B twice and then we got higher NPV. Pooja, I hope you are okay here. Okay, and what about others? Any doubts to anyone else? Any doubts from anyone else, guys? Okay, Smita says in repeating project multiple times IRR, but both times the same, but only NPV is higher. Yes, Smita, that's an interesting point. Smita, because the inflows pattern did not change. The inflow patterns did not change. That's why. We discussed that if there is a multiple outflow, IRR is anyway the challenge, but because the inflow pattern did not change, you get the same IRR. But I think in reality, I agree with what Pooja also said, that yes, how can we be so sure that the projects can be repeated? Then that's why it is important that we understand the equivalent analyzed criteria. Right, guys? So now we talk about a very, very important scenario. Just looking at the query panel. Okay, no queries as of now. Guys, please be attentive here. This is a very, very important aspect of some special cases or application of capital budgeting. Is when we are or any organization is posed with a question of replacement of existing machinery, what are the factors we need to consider? See, of course, we are talking about the cost of the new machinery, old machinery sale value, also what changes it will bring in our operating cash flows, any tax impacts on the sale of the existing machinery. All these factors are important. But can we in a nutshell conclude the replacement of machinery should be done only when the present value of my benefit should be larger than the cost? Yes or no? Do you agree, guys? Okay, a couple of questions. Prabhas, in equivalent analyzed criteria, PVF is selected for project life always. Yes, Prabhas. 6 years, 3 years, 4 years, whatever. Smita says in exam, if the project can be repeated. I would say, Smita, if there is no clear indication of the requirement, then you should. But I would say, I would expect question to be specific. What, if they are intending to ask you a specific method, if they are not, probably they are testing your knowledge. Okay, what could be the other possible scenarios? Then you don't mind, checking both the ways, right? I would go with that mindset. Okay, so guys, I was asking you guys a question on replacement of machinery. That should we replace the machinery if my resulting cost is more than benefit? Should we agree? Should we replace the machinery then? Yes or no? If the cost is more than the benefit, guys, what do you have to say? Let me look at the query panel. Yes, everyone, did you hear my question properly? That if my additional costs are exceeding my benefit, should I go with a replacement here? No. Sudhanshu says no. Okay, Prabhas says no when the cost is less than benefit. So that means everyone agreeing here with me that when the benefit is more than the cost. So how do we calculate and check this? Let's see this. How do we check this one? Now, in terms of the step one, we're talking about net cash outflow. We are looking at book value of the old equipment minus market value of the old equipment into tax rate. So basically, we are talking about the tax payable or savings from the sale. And I hope you agree with me that it is tax payable when it is a gain, tax saving when it is a loss. And then there is a cost of new equipment also, right? So if we net off the cost of the new equipment with the tax, either we add the tax payment or we reduce the tax saving, we get the net cash outflow. So what I am talking about is calculating the net cash outflow is the purchase of the new machinery minus sale of new machinery and plus minus the tax impact. That's the step one for us. Second step would be estimate the change in the cash flow. My focus is on this word change. Because there could be additional revenue, there could be additional cost, but you are talking about net change. There could be change in depreciation also. What if there is a change in depreciation? Take the tax shield loss on the additional depreciation. And then the step three is calculate the present value of those benefits, discount them. And then you calculate the NPV. So basically, guys, what we are looking at here is that similar to any other calculation, we are calculating the NPV for a replacement of machinery, but we are doing for incremental basis. We are doing this for incremental basis. What used to be the case? What is now the case? What has got changed, guys? I think, as always, best way to discuss this is look at an example here. So let's talk about this example. So the company here has a machine which has been in operation for 3 years. The machine has a remaining estimated useful life of 5 years with no salvage value in its end. Its current market value is 2 lakhs. Company is considering the proposal to purchase a new model to replace existing, and they're giving the relevant information. Now, if you see the relevant information, there is information about existing and the new machine. New machine, I'm more focusing on them. 10 lakhs, estimated life 5 years. And mind you, the old machine has already been in operation for 3 years, right? So if the old machine was already in operation for 3 years, and in the question they said estimated remaining useful life is 5 years, right? So that's okay now. 8 minus 3 is 5. And this is also for 5 years. So apple to apple comparison. No salvage value. Look at the annual output. From 30,000, the annual output is 75. Selling price is same. Annual operating hours is same. Even the cost is same. However, look at the labor cost. Labor cost has gone up. Indirect cash cost has gone up. So guys, if I want to understand this particular question in a nutshell, I am just thinking about, is it worth spending 10 lakhs on an additional savings of 45,000 units converted into monetary terms? As in, we know selling price is 15, we know material cost and labor cost per hour. So what we need to do is we need to calculate the incremental benefit. And the depreciation rule is 20%. And look at the information at the bottom. The company uses WDV, value of depreciation, at 20%, and you have several other machines in the block. Income tax rate is 30%, and Zavli does not make any investment if it yields less than 12%. The question is, should we replace the machinery or not? Now let's discuss this situation one by one. I would say, and rather I would ask you guys as a first step, what do you think? Will there be initial outflow? Yes, then how much? Remember my step one, guys. Step one, calculation of the initial outflow involves the purchase of the new machinery, less salvage of the existing machinery, and any tax impact. Please tell me, as a step one, what will be my net cash initial outflow? Who will tell me the answer? Net cash outflow, guys, initially in this particular scenario. Please tell me, guys. So the Hanshu says 7 lakhs. Okay, interesting. So the Hanshu says 7 lakhs. What about others? Okay, suddenly the answer is changing. Interesting. I'm liking it. So Hanshu, are you adjusting the salvage value or are you adjusting the original cost? Can you please check your answer? It would be great if you could just check your answer, please. While I'm getting other answers, 5 lakh 60 is one I'm getting. 5 lakh 60 is what someone told me now. I think Pooja. What about others? Okay, guys, I think I've got a couple of answers as 5 lakh 60,000, but please try to appreciate. What is the purchase price of the new machinery? 10 lakhs? What is the purchase price of the new machinery here? 10 lakhs? And what if you want to sell the machinery? Now, I know that there is no salvage value which is given to us, but their current market value is given 2 lakhs, guys. Look at the third line on the top. I would go with 8 lakhs, guys. I got answer 8 lakhs from Hiral, from Prabhas. I would definitely go with 8 lakhs. Guys, please try to understand here the right context. We are talking about that the cost of the machinery is 10 lakhs with us, but the existing price of the existing machinery is 2 lakhs. So your net initial outflow is 8 lakhs. But I would like to talk about something more here. Is there any tax impact here? Is there any tax impact here, please? Yes or no? Any tax impact? If you're saying no, then I would try to understand why. Sudhanshu, I do not agree. 3,30,000 was original cost of the machine 3 years back. So today we are standing on the beginning of the year where 3 years are already gone. So you incurred 333 years back. Why you are considering that? When you are buying the new machine today, you will be selling the existing machine at its existing market value, current market value, Sudhanshu, which is given to us 2 lakhs. Then why 10 minus 3.3? 10 minus 2 lakhs, na? Okay. Smitha's third line of the question. Please read the question on the top. Okay, couple of students are confusing with the tax impact as well, guys. I want everyone to please refer to the paragraph below the information. Give me a second. I want everyone to look at this paragraph. The company has other machines in the block of assets. Will there be a tax when there are other assets in the same block? Will there be a tax implication? We are talking about sale of capital assets, right? So why would there be a tax impact? That's my general question. You may be right, but I want you to think over. I am not talking about the tax impact on the profits, guys. I'm talking about the sale of the machinery. Please. We're talking about the sale of the machinery, please, guys. I think this is a very, very interesting discussion right now. So I want everyone to be on the same page. If there are other blocks in the asset, will there be a tax impact on the sale of the capital asset? I don't think so. Prabhas, this is exactly what I was talking about. And Hiral, I hope you got it. I think Hiral is the only one who gave me the correct answer. Hiral said that income taxes on business income, not on the sale of machine. Because there are other assets in the block. Pooja, the information is given to us in the question itself. Na? Company uses written down value and it has several other machines in the block. So guys, can you guys please confirm that everyone okay with the first part of the question? That my initial outflow is 8 lakhs, please. So that I can proceed to explain you this illustration. Till 8 lakhs, everyone is on the same page. Can we proceed? Prabhas, I hope you guys are also clear on the taxation part. So Gayatri, we will talk about the tax on the profit, depreciation, everything separate. This was a separate question where I was asking you the tax on the sale of the existing machine, nothing else. Yeah. Okay, so guys, 8 lakh is my initial outflow. Now, I want everyone to be careful here. I want everyone to be clear that my existing machine, when I acquired 3 years ago, was 3,30,000 and company had followed depreciation of 20% WDV. And my depreciation would have been hence 66,000, 52,800 and 42,240. So my WDV of the existing machine is 1,68,960. WDV of the existing machinery is 1,68,960. Now please try to understand the block of the asset concept. Let us say that this 1,68,000 is in the existing block and I acquire the new machinery for 10 lakhs. Hence, once I acquire this for 10 lakhs, I will sell the existing machinery for 2 lakhs. So what is the impact on the block of the assets, guys? 10 lakh is an addition. 2 lakh is a sale value. Again, the 1,68,000 plus 8 lakh, I am getting 9,68,960. What I am trying to prove is, even for the depreciation, the block will increase only net by 8 lakhs. Very simple. The block will increase net by 8 lakhs. Why? There is no gain or loss. There is no gain or loss on the sale of the asset because there was block of assets, as I said, no tax impact, no gain or loss. And hence, we are talking about, yes, my depreciation earlier would have been on 1,68,000. If I had not replaced the machinery, my depreciation would have been on 1,68,960. But now, since I have replaced the machinery, my depreciation will be on 9,68,960. So that means the additional depreciation is on only 8 lakhs. I like the term used by Pooja. Pooja says this is like a brain hurricane. Wow. Pooja, I haven't heard that kind of a term here. So guys, okay, the way to make it simpler, I think some of you are making a toll of it because you are thinking that, okay, this is a very technical question. This is very new for you. My own experience is that if you find some question tricky, the best way to tackle that one is to break it into baby steps. Take it into small steps, guys. Don't take it heavy on you. I'm trying to make it simplify by explaining you each step here. So guys, is everyone clear that the 8 lakh initial investment is actually the additional amount that will be added to the block? Yes or no? Because 10 lakh will be added, 2 lakh will be reduced. So your additional depreciation will be only on 8 lakhs, guys. Yes or no? I just want a confirmation that additional depreciation will be on 8 lakhs. That's it. I'm not concerned about the earlier block. Because other assets will be anyways be there. That is not my concern, right? I don't need the overall block value. I'm more concerned with the increase in the value because of the replacement of machinery. So 8 lakhs will be the basis for additional depreciation. Now, let us try to understand what the question was talking about, that if I purchase the new machinery, how many units you will be able to sell? 75,000, guys. From 30,000, I'm increasing to 75, so 45,000 increase. So let us compare existing machine on the right hand side of the screen. We were able to have annual output of 30, now 75. So we get 45,000 units additionally. So in terms of the revenue, because the selling price did not change, 15 rupees per unit. In terms of revenue, my revenue increased from 4,50,000 to 11,25,000. So hence, the incremental revenue is 6,75,000. I think material cost was same. So increase in the material cost is 1,80,000. Labor got slightly changed, guys. Labor got slightly changed. There was a cost per hour. Labor cost per hour was 40. So 40 into 3,000, it was like 1,20,000, but now it is 2,10,000. So basically, there is an additional cost of labor of 90 here. 2,10,000 from 1,20,000. Indirect cash cost increased from 50 to 65. So additional 15 here. So we are purely going with the incremental concept. Let me warn everyone here. You guys should be trying to be comfortable with incremental approach, because when we will be discussing towards the third week of this month about working capital management, there will be a similar illustration there also. We will be talking about incremental approach when we will be talking about account receivables management base. Prabhas, we are not taking capital gain tax because the asset is sold in exchange for the new machine. Also, Prabhas, there are other assets in the block. If there are other assets in the block, you're not calculating the gain, right? The block continues. So guys, interesting factor. My additional revenue is 6,75,000 here. Additional. My total additional cost is 180 plus 90 plus 15, that is 2,85,000. Hence, I'm talking about net 3,90,000 profit before tax and depreciation. But the interesting part is depreciation is yet to be considered. And even more interesting is that depreciation is on WDV basis. I want a quick confirmation from everyone. Till 3,90,000, is everyone on the same page? Is everyone clear? Everyone with me on this? Till 3,90,000. This is profit before tax and depreciation. Is everyone with me on this? And don't even worry, guys. As committed, after today's session, I will upload another PDF with all the solutions of the practice questions. Don't even worry. Okay, great. So, guys, 3,90,000 is the profit before depreciation and tax. We discussed that depreciation is on a written down value, and depreciation will be on the additional investment of 8 lakhs. Now, let's try to understand that. We have, for all the 5 years on your screen, the profit before tax and depreciation 3,90,000. Depreciation is on 8 lakhs for the first year, 1,60,000. Then it will be on the written down value, 1,28,000, 1,02,000, 81,000, and 65,000. Mind you, I hope everyone understand how the written down value is calculated. So this is 20%. We get 640. Another 20% of this is 128. We talk about 5,12,000. And then similarly, we'll calculate 20% of this. So this is how the depreciation is calculated here. Hiral, I'm fine with that. Hiral says that can we actually mention in step 2 that the base for increment depreciation is 8 lakhs? Absolutely. See, that was a little bit a longer way to explain you guys how we arrived at 8 lakhs. But if you understood the concept, I'm fine with that. That's okay. As long as, so don't miss out the steps though. But yeah, if you're understanding it, that's absolutely fine. Guys, depreciation calculation is okay with everyone? WDV, please. So you get profit before tax after reducing the depreciation for all the 5 years. And now someone said that tax is there for 30%. Absolutely. No? Who denied? Now I will deduct the tax of 30% from these numbers. 2,30,000, 2,62,000, and so on. And when you get profit after tax, please understand, don't forget to add back depreciation because it is non-cash. And that is why the net cash flow is column number 4 minus 5 plus 3. Column number 4 is profit before tax. Column number 5 is tax, and column number 3 is depreciation. We are talking about 4 minus 5 plus 3. So we are adding back the depreciation, guys. And you guys know, who knows better than you here? You guys know, we learned in the last class that we need to add back the depreciation. So don't forget that piece. And then we multiply all the relevant cash flows with the present value, and we actually get it at 11,06,000 here. And then there is a salvage value of the new machinery. I think that was given in the question itself, 40,000, the third row in the table. The salvage value is 40,000. Again, there is no tax impact over there. So 11,06,000 plus 22,680 minus 8 lakh, you have a huge positive NPV. And hence, we come to a conclusion that existing machinery can be replaced, guys. I want a quick confirmation. I'm giving you guys a minute to digest it. Let me know if there are any questions on any of the steps here. Just giving everyone a minute here. I can probably correlate to Pooja's comment. Pooja said that okay, it's a brain hurricane. But Pooja, do you agree that once you break this question into small steps, what you are left with is logic and the calculations? Absolutely correct. I think I got a comment. This is a little tricky, but once understood, easy to go with. So guys, do you agree with me that it involves calculations? That's okay. But if you understand the logic, it's absolutely interesting actually. Smita said that Smita was nervous for a few minutes. But Smita, are you okay now? I'm sure explanation of every step way we are discussing here, when you are practicing, do that. Talk to yourselves. Understand the logic and rationale behind every step rather than just for the sake of it reading it. Don't do that. So this is my humble advice. Even for practical questions, you should have logic for every step, guys. Khushi says incremental NPV is not clear. Why? Khushi, we discussed now, everything is incremental. Khushi, everything is incremental. If you see the last slide, even the revenue is incremental, cost is incremental, depreciation is also incremental, the initial cash outflow is also incremental. Everything is basically calculated on the basis of incremental stage. Khushi, I hope it's good now. Okay, guys. Would you like to have a quick look? Okay, so I'm having a similar question here, which I want everyone to do as a homework. I want you guys to try this out, and after the lecture, probably by end of the lecture today or tomorrow, I will be uploading a file which will be having the solution for this one as well. This is a very, very similar question where we talk about the replacement of machinery. Old machine versus new machine number is given here. You want to try it on your own. I would definitely go with the fact that yes, you need to try it on your own. Okay. Sudhanshu has a question. Why deduct the initial cash outflow of 8 lakhs? Sudhanshu, because you are talking about NPV. Incremental present value of incremental inflows minus present value of incremental outflow. Sudhanshu, makes sense. Okay, great. Pooja has a question. What about time management? Pooja, there are 3 ways to manage your time. Practice, practice, and practice. No shortcuts. Okay, jokes apart, guys. So, guys, this is a homework for you all. You guys need to practice this question, and then you can compare your, practice with the solution. I will be uploading this file probably by tomorrow maximum. And let's do one thing, guys. It's 7:20 here. Let's take a break of 10 minutes. After the break, we will have a recap of entire capital budgeting techniques. What all we discussed. And then on the other side of the break, we will probably try to do a practice of 3 or 4 questions. I have some questions for practice here. Then probably we'll also look at a couple of questions additionally as a practice or an assignment for you guys within the same PDF I've uploaded. So let's look forward for a very, very interesting session with a lot of practice on the other side of the break, guys. So let's take care. Let's take a 10 minutes break, come back with the full energy, freshen up yourselves, come back fast. So welcome back, friends. On the break, I hope everyone got a much deserving break, I guess. A tricky question before we went off for around last 15 minutes, mind absorbing. And I could see a couple of comments. Hiral is asking the same question. Hiral, I told you in that question, if you're talking about that particular step for the depreciation, if you want to rephrase or rather come up with the point that, okay, additional incremental base is 8 lakh just in one step, you should give your justification for that since this is a block of assets concept. Or probably, why don't you just kind of quickly mention that WDV of the existing machine is this much. This is the addition. This is the sale price. At least mention those 4 steps, right? So that the examiner gets the clarity. How did we calculate this? Here I just answer your doubt. I guess you reposted the query. Smitha, don't worry. For this particular topic, there are certain questions I have in my this particular PDF which I've already uploaded, which you guys will be getting as an assignment only. We'll be covering some questions in the class, some questions you are expected to solve at your end, and then you can compare with the solutions. So like one I just gave you for the replacement. So there are 2 questions over there. One we discuss in the class. The second I want you guys to do on your own. Okay. And similarly, we'll be having 2 or 3 more practice questions towards the end. So Smita, I hope this is what you are asking for. Okay, guys, time for a little bit of a recap. Let's do a recap here. We discussed non-discounting techniques that day, payback period. We said that, okay, the drawback was that it doesn't take into account the discounted or the time value of money. Accounting rate of return. We were talking about that you wanted the accounting rate of return to be more than the minimum acceptable return. The only issue was that it was based on the net income. Now we talk about the discounting techniques. We said about the NPV more than 0, except the project. Profitability index more than 1, except the project. We also talk about the discounted payback was much better acceptable method than the payback, but it ignored the profitability though. And IRR, we discussed that, okay, if it's more than the cost of capital, we should accept it because the NPV at cost of capital would be positive then. So this is something we have been discussing throughout. Time for a couple of brain teasers here, guys. I want you guys to answer this with the question number. If you're answering question number 1, mention 1A, 1C, whatever. So please mention the question number for both the questions here. Anyone who has answered any question yet? Okay, I can see the answers coming in already. I think these should be easy ones. Trust me. One of the question is straightforward. The other one we did today. But to my surprise, I'm getting contradictory answers for question number 1. How come? Yes, please read the question carefully. Release of working capital at the end of the project. Release. That means you introduce the working capital initially. You invested additional working capital additionally at the beginning of the project. But once you release that, why would it be an outflow in that case? It has to be inflow, guys. Majority of students mentioned as A, but I saw a couple of answers as B. Guys, those of you had mentioned B, is it clear? The word is release of working capital. That means you probably had invested additional working capital and now you're releasing it. So answer is A, guys. Let's move to question number 2. Now question number 2, Okay, let me give you some time to answer question number 2 also. But I'm already getting 2 answers for question number 2 as well. So question number 2 talks about multiple IRRs are obtained. Guys, I told you when does the multiple IRR happen? When there are outflows at multiple stages in the project, or in other words, can we say that the cash flows reverse their signs? I would go with option number B, guys, because just because my inflows or future inflows are uneven cannot be a multiple IRR, guys. Some of you mentioned option number C. I don't think so. It has to be option number B, guys. Everyone okay here? I hope we are good. All the questions. Pooja, it has to be B, not C, please. Uneven cash flows doesn't necessarily always bring in the multiple IRRs, right? It's when there are outflows at a later stage as well. Okay, guys. So now just give me a second. I want to double check something. And so there are few questions from there on in your PDF, but I would like to target some specific questions, guys. So guys, if you can see the slide, there is a comprehensive question. This is your first question as a kind of a homework for you guys, where you guys are doing a little bit of an analysis or applying. So this is a very, very straightforward question. I would like to rather cover some of the interesting and important questions in the lecture here. This is more for your practice, wherein you can rank the projects based on the payback, ARR, IRR, and so on. So the first question I would like to actually try in the class today is this one, the one which starts with unlock limited. Okay. So this is our question which I want to attack with everyone now. So Unlock Limited wants to replace its old machine with a new automatic machine. Now, two models A and B are available at the same cost of 5 lakhs each. Salvage value of the old machine is 1 lakh. Utilities of the existing machine can be used if the company purchases A. This is actually very interesting information. You should make a note of these things, right? Utilities of the existing machine can be used if the company purchases A. Additional cost of utilities to be purchased in that case are 1 lakh only. If the company purchases B, then all existing utilities will have to be replaced with new. So in that case, the new utilities is 2 lakhs. So you have more cost. Salvage value of the old utilities will be 0.2. So that is 20,000. So net is 1.80 lakhs. Target return on capital, that's your discounting rate, is 15%. We have to calculate the two machines, rather NPV separately, and also discounted payback and desirability factor. And we have to advise which of the two machines have to be selected. They've given us the inflows related to the machine A and B. Mind you, the initial outflow, that is the initial cost, is same for both the machines, is 5 lakhs each. So we have years 1, 2, 3, 4, 5. We have the present value factor given to us. And remember, there is a salvage value also given for both the machines. So let's talk about this. And the interesting part is they've already given us the earnings after taxation are expected to be. So don't even worry about anything else. Mind you, these are cash inflows after taxation. So don't worry about the tax impact on the depreciation and so on. They've already given. The only important point, probably in terms of the initial outflow, is you need to consider. So let me ask you this. I know everyone is so, pretty much well versed in calculating the present value now. What I'm more interested is, can you tell me, in case of machine A versus machine B, what is my initial cash outflow for machine A and machine B? Your answer has to be with A or B. You have to give me the answer for initial cash outflow for machine A and machine B both. Inflows are given in the question, so I don't even worry about inflows. Waiting for your response, guys. Shall be the initial outflow for machine A, or you can say net outflow, and for machine B as well. Okay, one answer is coming to be 1 lakh. Guys, please mention machine A or B. I would appreciate it. You can mention machine A is this much, machine B is this much. That's the outflow I'm looking at. Okay, Prabhas says machine A 5 lakhs, machine B 5 lakh 80,000. Interesting. Hiral says 4 lakhs. Hiral, which machine? Okay, let me tell you, both the machines are 5 lakhs, right? And the salvage value of the old machine is 1 lakh. So can we say that the net cost for both the machines is 4 lakhs? But what about the utilities? That is also initial outflow. In the case of A, you can use some of the existing utilities and you have to invest the additional utilities for 1 lakh here. So what we are talking about is 4 lakh plus 1 lakh, that is 5 lakhs here. But what about machine B? They said all the new utilities have to be purchased and the existing utilities will be sold for 20,000. So 2 lakhs minus 20 is 1 lakh 80. So we're talking about 5 lakhs here and 5 lakh 80,000 here, guys. I guess Prabhas and Khushi, you guys are absolutely spot on here. What do you think, guys? Everyone else is on the same page? 5 lakhs and 5 lakh 80,000, please. Everyone is on the same page? Smita, we need to add the. I think you got 4 lakh 80,000. I probably feel that the existing utilities will be sold in the case of machine B, not in machine A, right? Am I correct? Smita, is it okay now? Great. So I think everyone is on the same page. I think the only tricky part in this question is this much only, right? So let's quickly have a look at some of the calculations here. Now that everyone is okay that we get a 5 lakhs and 5 lakh 80,000, so this part is taken care of. Everything else is given in the question, right? If you see the cash flows which are given, like 1 lakh, 2 lakhs, so cash inflows are already given to us. Am I correct? However, in the year 5, do not forget to add the salvage value. So for machine A, it is 2 lakh 20,000. For machine B, it is 1 lakh. So I think everyone needs to be very much comfortable in the 5th year cash inflows also, because that includes your salvage value as well. Okay, guys. And Now the rest of the game is just multiplying with the present value factors. That's 0.87, 0.76, 0.66, and so on. So basically, what we need to consider is that yes, the project A is having a 43,800 NPV. Project B is having 19,300. Hence, project A is selected as far as the NPV is considered. The second requirement was discounted payback period and desirability factor as well. Now, desirability factor is very much simple. Like we divide the present value of the inflows upon the outflows. So we get 1.09, again the project A. And when it comes to payback period, guys, you need to calculate the cumulative inflows here. For the discounted payback, you have to calculate the cumulative ones. So 87, 2 lakh 1,000, 3 lakh 19,000. And how much was the outflow? 5 lakhs, right? So we're getting like 4 plus here. So 4 years plus something. So we got 4.60 for project A and 4.61 for project B. So marginally, I would say still project A is selected. Yes, everyone with me on this? Any doubts? All okay here? I hope everyone okay. All the three methods, we select only one project, project A here. Great. Now let's move on and let's have a look at another very interesting question. Now this is one of my personal favorites, guys, and I'm sure you will also like this question, but you need to be extra careful. Don't even miss out on any of the possible outcomes for this one. Now this question, as it pertains to not Bajrangi Bhaijan, but it is like Bajrangi Chimney Company. So they are evaluating 3 investment situations. One, producing a new aluminium chimneys. Second, expand to its existing line, some additional variants. And third is moving on to exhaust. In this question, trust me, almost every statement becomes very, very important. Look at this. If only one project is undertaken, then standalone expected present value and the amount of investment is here below. What are we trying to say is that if we are evaluating independent projects, we are given the investment and present value of the future cash flows. That's very interesting, right? In this question, very interestingly, we are not even going for any calculations, to be very honest. But what we need to be very careful is whatever the maximum permutations and combinations of the projects can be given to us. So if we have to select, if you have to go for the standalone project or only one project, we know that this is my present value future cash flow. This is the investment required. We can just compare these. 2 lakh 90,000, we get 90K. Here we get 70K. Here we get 1 lakh 30K. Now 1 lakh 30,000. So the idea here is that, okay, as much as it seems to be that, okay, hey, project 3 looks good, but hold on, that's not the requirement of the question. That's not the requirement of the question. We are talking about some additional information given to us. Let us see those additional information. If projects 1 and 2 are jointly undertaken, if projects 1 and 2 are jointly undertaken, there will be no savings, investments required, and present values will be simply the individual totals. So can we say, if we are talking about project 1 and 2 taken together, we are simply talking about 1,60,000 NPV. We just add these two. There is no economies of scale. There is no savings from each other. The resources are not able to be kind of shared with each other. Now, That is a kind of a similar setup. Let us look at the other possible combinations. With projects 1 and 3, economies are possible in the investment because one of the machines, now this is interesting. Economies means that you can probably utilize the resources of both the projects. One of the machines acquired can be used in both the production processes. The total investment required with the projects 1 and 3 would be combined as rupees 4,40,000. Guys, please bear with me here. We are talking about 4,40,000. What would have been the scenario? What would have been the scenario if you were doing project 1 and 3 independently? My investment required was 2 lakhs and 2,70,000. Do you agree that I saved something here? Instead of 4,70,000, I am incurring only 440. So I'm saving something, right? I'm saving 30,000. If I would have taken these projects, the total investment was 4,70,000. But now I'm saying that I got 4,40,000. That's amazing. So we are not incurring 470 here. So let us see the combinations. Project 1 and 2, no savings. Project 1 and 3, there are savings in the investment. Let us look at the other combination. Projects 2 and 3, there are economies to be achieved in marketing, that is in expenses and in cost, but not in the investment. So the present value of the future cash flows for project 2 and 3 will be rupees 6,20,000. Now, interestingly, if I see project 2 and 3, I'm getting 5,85,000. Probably I would have incurred some costs, but if I combine them, my costs are being saved. So instead of 5,85,000, I'm actually getting 6,20,000. Everyone with me on this till this point? Now, another possibility, what if I take all the 3 projects? If all the 3 projects are undertaken simultaneously, the economies noted will still hold. Guys, what are the economies holding? Or probably what are the economies which were there with the combination? I think there were only 2 combinations which were giving me any saving, 1 and 3 and 2, 3. Am I correct? So if I talk about 1, 2 and 3, basic economies noted will still hold. However, there will be an additional investment of 1,25,000 on the plant will be necessary because you cannot hold the 3 projects in the same space. So that means if all the 3 projects are there, what was my investment originally, guys? 1 and 3, 440. And for the project 2 is 1,15,000. And then there is an additional 1,25,000. So this 125 is additional. And hence, we are talking about total investment of 6,80,000. Am I correct? Everyone agreeing with me here? 680. Yes, Hiril. So Hiril is like kind of justifying that yes, the gadgets, how they can be useful in the other projects. Absolutely correct. Hitesh, absolutely. So investment is 6,80,000, but what would be the inflow? If I do all the 3 projects, I think we get 6,20,000 from 2 and 3, and then we have 290. So we're getting 9,10,000. So my NPV becomes 2,30,000 here. That means if I see the requirement of this question, advice on what combination shall be best. I'm seriously bamboozled by the question. But at the same time, if I just keep it simple, do you agree that it's actually not complex? We just have to compare the NPVs of all the possible combinations. Now think about the possible combinations. One would be doing the standalone project, guys. 1, 2, and 3. This is like one possibility that, okay, I only undertake these 3 projects individually. Other possible combinations they have given to us: 1 and 2, 1 and 3, 2 and 3. 3 possibilities. And one possibility is all the projects taken together. So guys, I'm talking about 7 possibilities here. 7 different possibilities. So let us plot all these 7 possibilities on one table. And let's focus on the last column here, guys. NPV. We got, I think we calculate this 90, 70, 1,30,000, that's okay. But when I look at these possible combinations, it is very much evident that I am getting a best NPV when I'm doing project 1 and 3. Project 1 and 3, guys. Everyone okay with me? So the colors combination are just for your simplicity. The one in greens are talking about the savings in the investment, and one in blue are talking about the savings in the cash flows. So 1 and 3 are the best, or rather is the best combination here. Any questions, guys? Any questions from anyone? Please let me know. Let me quickly check the query panel in the meantime. Seems no questions. I think you guys are comfortable with this one. Guys, can you please confirm this is okay to everyone? Okay. Then we move on. The second question I would like to talk about here is the one on the screen now. Now, with this one, we're talking about a large profit-making company is considering the installation of a machine to process the waste produced by one of its existing manufacturing process to be converted into a marketable product. At present, the waste is removed by a contractor for disposal on payment by the company of 150 lakhs per annum for the next 4 years. Contract can be terminated upon installation of the aforesaid machine on a payment of compensation 90 lakhs before processing the operation starts. This compensation is not allowed as a deduction for tax purposes, so no tax saving in there. Machine required for carrying out the processing will cost 600 lakhs to be financed by a loan repayable in 4 equal installments, commencing from end of the year 1. And we are talking about interest rate as 14%. At the end of the 4th year, the machine can be sold for 60 lakhs and cost of dismantling and removal will be 45. Now, they're giving you the details of the sales and direct cost of the product emerging from the waste processing for 4 years. And not only that, they are giving you some information with respect to the initial stock, the stock levels to be maintained after that. Initial stock is 60 lakhs, and then you're talking about 165 lakhs and so on. Storage of materials will be resulting in a opportunity cost, I would say. I hope you remember that. We discussed the opportunity cost. Hiral, after this question now, Hiral, you want me to go back to the chimney question? I think we need to just wait for some time now. I'm on to the middle of this question. Okay, so I will go back and clarify a doubt after we complete this. Okay. So we're talking about the storage of materials will utilize the space which could have otherwise been rented out for 30 lakhs. Is it an opportunity cost, guys? We discussed that as a relevant cash flows. Labor costs include wages of 40 workers whose transfer to this process will reduce the idle time of payments of 45 lakhs in the year 1 and 30 in year 2. Factory overheads include apportionment of overheads except to the extent insurance charges 90 lakh on this venture. They're giving you the present value factors here. The question is whether you should be installing the machine for processing the waste. Sounds a big question, right? But can we simplify in what is the requirement? In understanding the requirement here, we have two choices, right? One, we get a machine, install the same for processing the waste, and the product would be more of a reusable or marketable one. On the other hand, presently, you have a contract going on, you are incurring 150 lakhs per annum for the next 4 years. Right? If I want to understand, okay, one more thing important is, if you want to actually terminate the contract, so there is also a requirement of additional compensation of 90 lakhs. But do you agree that means if I'm actually installing a machine, that the initial outflow is not only be 600 lakhs, but also this 90 lakhs will be there because this is a penalty. Because I am actually breaking a contract. Does this make sense to everyone? Yes or no? So we are actually talking about that also included as an initial outflow. Yes or no, guys? The 90 lakhs. Can I get a confirmation, guys? Yeah. Okay. So the interesting part is the 600 lakhs may not be required to be paid immediately. Right? So it's not actually 690, but probably we're talking about 4 equal installments. 4 equal installments. So that's good for us. Now, let us try to understand the overall impact in terms of the sales of the marketable product and also the initial outflow, and compare whether this seems to be a good venture or not. Let's talk about this one by one. Now, on the screen, you can see a statement of operating profit of processing waste. If you look at the sales number, we're talking about 966 and 1254. So all the numbers are in lakhs though. This is basically given to us. Material consumption, wages, all the expenses are given to us. Depreciation is given to us. So this is like an easy job, not that tough. However, I would like to show you something very important. If I look at the wages number, we are looking at 225, 225, 255 and 300. But is there any information given to us for the wages, guys? Is there any information of the wages? Don't you think there is a paragraph which is saying that labor costs include the wages of 40 workers whose transfer to this process will reduce the idle time of 45 lakhs in year 1 and 30 lakhs in year 2? So that is a saving, right? Pooja, I will talk about the penalty in a while. But everyone agreeing that that 45 and 30 lakh is a saving in this. So 45 and 30 lakhs. And that is why you could see wages of year 1 and 2 is net of idle time. That is considering the savings. So it was 225 and 225, but we are mentioning 180 and 195 here. And third and fourth year remains the same, guys. Everyone okay with wages here? And then we talk about other expenses, which is again taken as is 120, 135, 162, and 210. So is the case with the factory overheads as well. But the point is, we need to consider this aspect when we are talking about the factory overheads. Can anyone tell me what is the important point here? In terms of the factory overheads. The factory overheads, if you see, there is information given to us, include apportionment of general factory overheads except to the insurance charges of 90 lakhs. Do you remember my discussion on Saturday on the relevant cash flows? Did we discuss that allocated overhead need to be excluded because they are anyways incurred? Yes or no? Should we include the entire factory overhead? These are allocated, right? I would only include that part of the overhead which is additionally incurred for this project. That is 90 lakhs of insurance. And that's what we have done. So other allocated factory overheads are excluded. We're only talking about 90 here, the insurance. Everyone with me, guys? And although there is no other information, okay, don't worry about the depreciation as of now. We'll be talking about the depreciation as well. But you can see one line item, that is opportunity cost, loss of rent, the space that could have been given on the rent. So the question said that, okay, you could have let out the space otherwise. 30 lakhs, that's an opportunity cost. So hence, earning before depreciation, interest and tax is after considering all this is given here. So getting a 456, 396, 462 and 369. And then there is a depreciation given to us. Within the question, we reduce the depreciation. We talk about the interest. Can anyone tell me how do we calculate the interest here, please? How do we calculate the interest, guys? So we have a 600, right? 600 lakhs. Everyone here? Is everyone okay here? So 600 into 14% is 84. Then we are talking about 450 because you're paying in the 4 equal installments. 14%, 63. 300 into 14%, 42. And last year, 150 into 14%, 21. Because there is a 4 equal installments for the loan. And hence your interest will go down. And then we're talking about after tax profit given to us at the bottom. Any doubts on this calculation, guys? Any doubts on this calculation? Please let me know. Any doubts? Okay, if everyone okay with the profit after tax. Now, guys, this is only half the job done. Am I correct? Do you agree that this is only the half the job done? Yes or no? We had just calculated at what will be the profits if we actually go for this. But there is other side of things also. But this is only the profit. What about the outflow? What about the situation when we would not have undertaken this? Mind you, we are talking about profit, but there are outflow in terms of the 150 lakhs every year, 600 lakhs in 4 installments, penalty of 90 lakhs. So let's move on. This number will compare with how the incremental cash flows taking into account the outflows as well. There is a very important aspect on the top of this page. Initial stock of materials required before the commencement of the processing is 60 lakhs. And they're saying that the stock level, so they're talking about some outflow which may be required of 60 lakhs. Stock levels to be maintained at the year of 1, 2, and 3 will be 165 lakhs, and the stocks at the end will be nil. Can anyone tell me what does this indicate? I told you something on Saturday. Would be definitely highly impressed if someone can tell me what does this indicate? In simpler terms, what does this indicate, guys? No responses. Guys, don't you think it's a kind of a working capital required here? So we are talking about 60 lakhs in the first year, and then 60 lakhs initially, 105 additionally in the at the end of the first year, because you want to increase your inventory to 165. 60 and 105. So if I'm looking at year 0, I'm looking at 60, year 1, 105. There is nothing at year 2 and 3. But at the end of the year 4, this entire 165 will be an inflow for you. Release of working capital, guys. Does this make sense to everyone? We specifically talked about working capital on Saturday. I intentionally took this question because this can be tricky here. So let's have a look. So when I'm saying that it's a material inventory, you can construe that as a working capital. So 60, 105, and then entire 165 here. Okay. Pooja, you had a question earlier, 90 lakh penalty, right? So you had a contract of wastage removal. Am I correct? If you want to cancel that contract and actually do this kind of a manufacturing, you have to pay the cancellation penalty here. That's a 90 lakh outflow. And since you would be doing that, there will be a saving, right? Now the contract payments avoided. Very interesting. What contract payments? 150 lakhs. You were supposed to pay. Now you are not paying that 150 lakhs. But mind you, if that 150 lakh was paid, that would have brought a 30% tax saving. So net, I'm talking about 105 saving every year. Guys, everyone with me on this? Is everyone with me on this? So when we include our earlier calculation of profit after tax, 155.4, 153.3, along with this discussion here, can we say that yes, we have a profit after tax plus depreciation can be compared with this? Yes or no? Everyone with me on this? Now, my profit after tax was 155, 153, and so on. But of course, there was a depreciation which we need to add back, right? So this number is profit after tax plus depreciation. Plus depreciation. Then there are loan repayments, 150 every year. Sale of machinery happening at the end, which is given to us. If we talk about sale of machinery, machine could be sold at the end of the 4th year for 60 lakhs, but there will be costs associated with the dismantling of 45. So net, there is an inflow of 15 lakhs over there. What I want you to consider is the row. Okay, Hiral has a question. Why don't we divide 105 in second and third year also? Hiral, I have an interesting question for you. If my ending inventory, I have already purchased 165 and I needed the same levels here, why would you purchase more? You needed same level, right, in all the 3 years? Hiral, you needed same level of inventory for all the 3 years. So we just want to increase the inventory at year 1 and that remains same for year 2 and year 3. No need of additional investment. I hope this is clear now. So combining all these, guys, please listen to me. The profit from the operations, the loan repayment, and the contract payments avoided. Everything added here gives you a net total incremental cash flows here, which is 150 in the initial year. What is this 150? Working capital or inventory of 60 lakhs, cancellation penalty of 90 lakhs. And these two, your profit after tax plus depreciation, net of the loan repayments, 155. Am I correct, guys? Is this making sense to everyone? Let me know any doubts. Because 105 is kind of netted off for year 1. For year 2 and 3, they're also talking about that there is contract payments cancelled, but there is no additional investment. So there is an additional savings of 105 for year 2, 3, and 4. So that means for all the 4 years, we are looking at a 155, 222, and 274 number in terms of the incremental cash flows. I want everyone to please let me know if there is any question here. We are talking about total incremental cash flows, including the working capital, including the profit after tax from the operation, including the contract payments avoided and loan repayments. And the present value gives us a total positive NPV here, 577.37. And the interesting part is, even if we consider the taxation aspect on the capital gains, even then the NPV would be still positive. My humble question to you all is, would you go for this project with this kind of a savings? Would you go for this project with these kind of savings? Yes or no? I think I would go ahead with this. Mind you, again, some of you might be thinking that, okay, this question entails too much of information, right? How to keep it simple? I think probably take all the inflows together, take all the outflows together and net them off. That's what we have done. Take all the inflows together, take all the outflows together and net them off. Guys, everyone okay here? So Hitesh, Pooja, Hiral, everyone agreeing here? What about others? Smita, Siddhant, Prabhas, you guys are fine? Any questions, let me know, please. This is a good question. What you need to be careful is about a lot of information taken together. Should not be bamboozling you, should not be confusing you. Okay. Okay, folks. So let's move on now and talk about one more question probably for the day. Give me a second. Okay, guys. So you can see a question on the screen right now. The question pertaining to City Clap. Now, City Clap Limited is in the business of providing housekeeping services. There is a proposal before the company to purchase a mechanized cleaning system for a sum of 40 lakhs. The present system of the company is to use manual labor for the cleaning job. So present system is a manual labor, and we are talking about a mechanized automation. Proposed mechanized system, cost of the machine 40 lakhs. That's okay. We have given that. Life is 7 years. Depreciation 15%, and the operating cost is your 20 lakhs. Manual labor, that is in case of present system, 350 persons. Cost of manual labor is 15,000 per person per annum. Okay. Hiral says my earlier some question. Hiral, I will take your question shortly. Okay. Pooja says contract payment avoided is 150, right? But it is given as 105 on the screen. Pooja, that was net of tax. If you would have paid 150, you would have paid tax also. No, 30%. Sorry, tax would have been avoided, right? You would have saved tax because of that expense, so net of tax. That would have been expense, right? That is why. Pooja, I hope that makes sense. Okay, yes, coming to this, the requirement is we have to determine whether it is advisable to purchase the mechanized cleaning system. You need to tell me, what can we compare here? What can we compare here? I would say I would compare the cost first, and then I will compare the cash flows part as well. What do you think, guys? Or we can nutshell say that we are talking about the savings in cost. That's it. Because they're talking about cost of the existing system and cost of the new system. So we can compare that. Am I correct, guys? That's what we can do. So for example, what is the cost of manual system here? 15,000 to 350, guys. 15,000 to 350, yes or no? And that comes to be a 52 lakhs 50,000. 52 lakh 50,000. So that is my cost of the manual system. Then we are talking about what is the cost of the new system here. 40 lakhs. But there is a depreciation also. There is an operating cost as well. So what is the total cost, guys? What is the total cost? Can anyone tell me? 20 lakhs plus depreciation of 6 lakhs, 26. So we're talking about the cost of the mechanized system. Hence, there is a savings per annum of 26 lakh 50,000. Now, someone may say that, okay, why were you considering the depreciation? Because We will be taking care of the tax shield now. So if there is a savings, will there be a tax outflow? Tax is huge here, 50%. So that means savings after tax is only 13,25,000, and then we add back the depreciation. Remember my methods of depreciation, method 1 here. So we add back the depreciation and hence the cash flow per annum is 19,25,000. I want a confirmation from everyone whether you guys are clear till this point. What I did was we took the cost of the manual system separately. We compared that with the cost of the mechanized system and we talked about the savings. Savings was 26,50,000. That savings would have resulted in a tax liability as well. And then we added back depreciation. And then we calculate the present value, which gives us a 93,68,000. And as compared to the cost of the machine, we are talking about a big savings here. That means you should be going for automation here. Yes or no? Should we go for the automation, guys? Should we go for the automation in this case? It's clear cut. Yes, NPV is positive. Everyone else? So Hiral, Pooja, Smita, where are you guys? Any doubts yet? Please let me know if you want to ask anything, clarify anything on this question, guys. Please let me know. Okay. So guys, there was a question from one of the previous questions we discussed of the chimney, right? Hiral, you wanted to ask a question on that, I guess. So I was like parking your question earlier, but let me answer that question now. Your question was how come 910, right? 910. It was pretty straightforward, isn't it? We were talking about cash flows, right? 1, 2, and 3. And we said the economies will hold. So basically, how I'm taking 910 is 2,90,000 from project 1 and project 2 and 3 taken together giving me 620. So we're getting 910. Hiral, I hope that makes sense. Okay. Question from Pooja. Pooja says, why is depreciation added and not reduced? Very good question. Pooja, what exactly are we doing here? We are comparing cost to cost so that we can take the net of tax impact, and depreciation is a cost there. We're just seeing what is the cost of the manual system and what will be the cost of the automated system. That's it. So we included that in the total cost. So 26 lakhs is my total cost. Then we reduce the tax because there will be a tax saving on the cost. And then we added back the depreciation again. Because my savings will be actually net of tax because that's a cash flow. Siddharth, I think just coincidentally, I answered your query as well. Siddharth, is it clear now? Please focus, guys, that we are talking about savings here. Savings in cost. Do you agree if the savings in cost is actually resulting in profits? And because there will be profit, there will be tax. So we took the net tax, but because the cost had depreciation and depreciation is non-cash, we added it again. Okay, Hiral, because in that question, there was a specific information given in the question that if you were taken 3 projects together, the economies will hold true. If you had taken all the 3 projects, the economies would hold true. That was given in the question. Guys, everyone with me on this? Okay, so folks, now as we move towards the end of the session, I would like to give you a few questions as an assignment. I'm sure you guys have the PDFs with you. I will be uploading the results by tomorrow. So let me see. There are a few assignments for you guys. Broadly 3 questions. And I'm sure you guys will be able to do the 3 questions as an assignment, as a homework. Everyone ready for that? Okay. So the first question of the assignment is, let me show you, which is on your screen now, which is ANR Limited. And we are talking about, in this particular question, about some kind of a initial investment in plant and machinery. And with that project, there are some changes, there's some revenues, and we have to calculate the NPV of the project. But the interesting part in this question is the second part. Okay, the first part is fairly easy. Second part is you have to bring in some variations, decrease the selling price by 10%, increase the cost of plant and machinery by 10%. This is interesting because we are talking about the sensitivity of the project. What will happen to the sensitivity of the NPV? How much it will go up, how much it will be going down. So basically, in this particular question, this is a very, very good question. We are virtually calculating the NPV multiple times. We are initially calculating the NPV, and then we are also calculating the NPV considering these 2 scenarios. So basically, the one question you have to calculate 3 times NPV under 3 different scenarios here. So this is your first question as an assignment, guys. I'm sure this can take time, but be careful while you attempt it. Okay. Next question of your assignment would be this one. Shiv Limited. Now, this is something we have already done, right? The existing machine, new machine and all. So the question is related to the replacement of the machine. So that's okay. I think this one you should be finding it easy. And the last question as a homework. So basically, I'm giving you total 3 questions now, and 1 question earlier I already gave you. So basically, we need to understand that, yes, these questions are important for practice, and I want you guys to do the practice. So can I get a promise from you all that you will be able to do this, this practice maybe in a day or 2? Because trust me, you should hit the iron when it's hot, right? So that's very important. Now the concepts are fresh in your mind. You are in that mode of practice. So more and more questions you practice, the better you will be in terms of the capital budgeting applications. So 3 to 4 questions at your end, guys. Please try to complete. Do some practice. The file with the solutions will be uploaded for you guys to compare where you are going wrong, if at all. If you go it like pretty much well in the first instant itself, and you are probably almost there without any help, that would be great. That means you're able to apply the concepts in a proficient manner. But the idea is that, yes, we need to be disciplined. That's very important. Okay, guys. So I think that brings us to the end of the discussion on the capital budgeting note. Thank you all for joining in. I'm sure we enjoyed all the concepts. I enjoyed your company with the kind of responsiveness, with the kind of proactive responses. You guys always ask your queries there in itself and be proactive in the class. But I think it will be more or less important that you take the advantage of these lectures and do practice as much as you can. I've already incorporated additional 3 questions in the PPT, and I hope you guys can cover up the same in the next couple of days. And then I will be meeting you probably almost after a week or so. We'll be working through a very, very important module together. That's working capital management. So good job, guys. A grand applause for everyone to be so interactive. So wish you all the best. Continue the hard work, and always remember that your hard work, dedication, and discipline, those 3 things have to be incorporated forever. So take care. Best of luck, and just be safe, and happy learning, guys. Good night. Cheers.